Many investors feel anxious when the stock market takes a downturn, watching their portfolios shrink. But what if I told you that a declining market could be your best chance to secure a more prosperous retirement? As a financial advisor, I can explain why converting your traditional IRA to a Roth IRA during a market dip, especially when you own technology stocks and they're down, it could be a very strategic move. A Roth conversion involves transferring assets from a traditional IRA to a Roth IRA. This process requires you to pay income tax on the amount converted, but it offers the benefit of tax-free growth and withdrawals in the future. The key advantage of executing this conversion during a market downturn lies in the lower valuation of your assets. Lower valuation means lower taxes. When the market is down, the value of your investment decreases, of course. Converting at this time means you'll pay taxes on a reduced amount. For instance, if your traditional IRA was valued at $100,000 but is now down 30% to $70,000 due to the market, converting now would result in taxes on that $70,000 instead of taxes on $100,000 for the same amount of shares. This approach can lead to significant tax savings. By converting when prices are low, you can transfer more shares of good companies into your Roth IRA for the same tax cost as when prices were higher. This means a larger portion of your portfolio benefits from the Roth IRA's tax-free growth potential. Once your assets are in the Roth IRA, all future growth is tax-free, provided you meet the necessary conditions. If you believe that the stock market, and particularly the stocks that you're going to transfer, are going to rebound in the short, medium, or even long term, any appreciation will occur in the tax-free environment, maximizing your after-tax retirement savings. Now, there are two primary methods to execute a Roth conversion. One is the in-kind transfer. That's the ones we're talking about here. And this method involves directly transferring your existing investments from the traditional IRA to the Roth IRA without selling them. It's typically preferred because of simplicity. It avoids the need to sell, and it avoids the need to repurchase the assets. How about market exposure? It also eliminates the risk of missing out on market rebounds during the transfer process. And then cost efficiency. It reduces transaction costs of commissions of buying and selling. For example, if you have 100 technology shares worth $100 each, that's $10,000 in total, but are now valued at 70, they went down 30%, like in our top example. Now they're valued at $7,000 total. Transferring these shares in kind means you'll pay taxes on $7,000. That growth is tax-free if the shares rebound to $100 or higher. Now, sell and repurchase in this less common method involves selling the assets in your traditional IRA, converting the cash to a Roth IRA, and repurchasing the same or similar assets. While this approach can be used, it may expose you to market timing risks and potential transaction costs. While a down market can make Roth conversions attractive, it's essential to consider the other factors. For instance, what tax bracket is it going to push you into? Ensure that your conversion doesn't push you into a higher tax bracket, but that's not a rule that always works. So it's another one of those golden rules that sometimes, most of the time, works. Sometimes there might be a reason to convert, even now, if it pushes you to a higher tax bracket. We are in the beginning of a year right now, and the market's down, but we don't know what your whole tax situation is going to be this year. Remember, the longer your investment time horizon, the more you're going to benefit from the tax-free growth. Be aware that the valuation for tax purposes is based on the closing price on the conversion day. If you initiate the conversion during market hours, the actual tax cost may differ slightly from the value from when you started the process. Market downturns can be unsettling, but they also present unique opportunities. by strategically converting a traditional IRA to a Roth IRA. During these times, you can reduce your tax burden and position your investments for tax-free growth. So consult a financial advisor to determine if this strategy aligns with your goals and circumstances. Thanks. Subscribe and like the video, and the next video will give you another strategy to use when the market's down like it is over the last couple of weeks. Thanks.